So this analysis makes a really strong bullish case for BMNR stock. It's arguing for a, 60% upside based on its huge Ethereum treasury and future staking revenue. Let's just jump right in.
Yeah, the core idea is really clear, that BMNR is basically a leveraged play on Ethereum. And it's trading way below that analyst target of $53.50. It's a clean, compelling thesis.
It is. But that conviction, it needs to be backed up by a completely bulletproof analysis.
Especially for an institutional reader.
Yeah, exactly. So let's start there, with the overall completeness. For a financial analysis to really land, a report has to strengthen its own argument by getting ahead of the main counterarguments and just neutralizing them up front.
I completely agree. The report as it stands, it's almost all bull case, right? It hits the 3.63 million ETH treasury, the big institutional names, the high beta.
Right.
But it totally skips any structured talk about the obvious risks, the big ones.
And that's the core weakness we see. That imbalance, it's probably not intentional. It's just so focused on the upside, but it really risks hurting the credibility. I mean, analysts, they aren't just looking for upside. They're paid to manage risk.
They need to see resilience.
They need to see that you've already thought through the volatility, the regulatory stuff, all of it.
So the suggestion here is pretty critical. You need to add a brief, dedicated section that tackles those risks head on.
But the framing is key. It's not a warning label.
No, not at all. It's a power move. It's framed as a demonstration of how BMNR strategy is already built to mitigate these issues. It shows you're in control of the whole story.
It's about answering the tough questions before they're even asked. A portfolio manager has to justify this position, and that means they need a paper trail on the downside.
Okay, so for a concrete example, you have to run the numbers on the downside.
You have to.
You have to explicitly ask, what happens to the net asset value, the NAV, if Ethereum tanks by 30%? We all know it can happen.
And the point of that exercise isn't to predict a crash.
No, it's to show that even in that scenario, the stock's valuation is still attractive compared to its current price of around $33. It proves there's a margin of safety.
That's the de-risking step. It shows there's a buffer, but we also have to look forward at the project-specific risks. I'm thinking about Project Maven.
Yeah, building on that, AVN is huge for the thesis. It's the Made in America Validator Network. The analysis has to talk about the regulatory risks of that. I mean, we're talking about a massive centralized staking operation in the US.
Right. What does that mean?
It needs to detail how the structure of AVN, or maybe its partnerships, actually makes it safer than, say, some decentralized international option.
Is that Made in America part a deliberate move to comply with US regulations?
Exactly. Like KYC-DML rules or sanctions. If the report can show that the whole thing is engineered from the ground up to avoid regulatory problems, that makes the future earnings streams so much more believable.
It reduces the chance of a shutdown or a big fine down the road.
Right. It takes the risk profile from who knows to managed and compliant.
And doing that, just integrating that bear case neutralization, it immediately elevates the whole piece from a convincing pitch to proper institutional grade due diligence.
Okay, so once the resilience part is covered, the next logical step is showing the math behind the reward.
Let's move on to that. The second big opportunity here is about the significance of that cash flow catalyst.
This is the exciting part for me. The idea of BMNR going from just holding a volatile asset to becoming a, quote, cash flow generating giant from staking, that's the real story.
It is. It's the entire reason for that 60% upside call. But here's the issue. The report needs to build a quantifiable bridge between that future staking money and the $53.50 price target. The narrative has to become math.
As it is now, it feels like it leans a little too much on this kind of abstract idea that, analysts are pricing this in. It's asking the reader to trust the consensus.
Without showing the work.
Yeah. The link between the future cash flow and why the stock is mispriced today isn't quite solid enough.
It leaves the biggest question on the table. How much of that staking potential is actually in the target price? So the suggestion is to introduce a simple illustrative model, a valuation decomposition.
This is a must-have for any serious analyst reading this. It should break it down, show me how much of that $53.50 target comes from the East Treasury today, the volatile part, and how much is justified by the future recurring revenue from staking.
Right. It turns the target price from just a number that analysts agree on into something you've derived yourself.
That's the key.
So to make this actionable, the report needs to use a conservative staking yield. Don't go crazy. say 3 to 5% annually,
Mm-hmm.
and run that on the 3.63 million ETH to get a realistic recurring revenue number.
And you've got to make that number tangible. I mean, even at a midpoint, you're talking about tens of millions in new, predictable cash flow. For a company that's currently valued on asset swings, that's a game changer.
It's the whole delta. And then the next step is show, maybe with a simplified DCF, a discounted cash flow model, how that revenue stream adds a specific dollar amount per share to the target.
You need that line item. You need to be able to say, for example, the staking revenue accounts for exactly $8 per share of our 5350 target.
Yes.
That kind of clarity shows the exact reason for the discount at today's price. It makes the so what of Project Maven crystal clear. It shifts the whole valuation mindset from today's price swings to the long-term predictable utility of the ETH they hold.
And that's how the narrative becomes math. Okay, so let's move to the third refinement. This is about the context around the valuation anomaly itself. The report leans heavily on the trailing PE of about 2.37.
Okay, yeah, let's talk about that. Because while a PE that low obviously screams cheap, that metric gets so distorted for companies holding massive crypto treasuries. It's all because of how unrealized gains flow into net income under GAAP.
It's basically noise. Using the PE as the main proof of mispricing, it kind of oversimplifies the stock's high beta nature. It doesn't explain why the market is already ignoring that high net income figure.
We see this all the time. People try to cram a volatile crypto holder into a traditional PE box, and it just doesn't fit. So the argument needs a more robust valuation context. Providing that will actually reinforce the thesis and clarify what leveraged returns really means here.
The weakness is that simplification. Using PE alone doesn't address the risk discount you'd expect from a beta over 2.0. I mean, that high beta signals huge volatility, and the market is smart enough to demand a discount for that.
So the fix is to bring in metrics that are actually designed for this kind of company, specifically price to NAV per share. And then you have to strategically discuss the trade-offs of that high beta.
Exactly. Instead of a wonky PE, you calculate and highlight the discount to the current net asset value per share. That's the metric that matters when you're being treated like a leveraged ETF or a closed-end fund. It cuts right through the accounting noise.
This is so important because the market is mostly valuing the assets BMNR holds, not the accounting profit it generates. If you can show it's trading at, say, a 20% discount to its liquid NAV, the undervaluation argument is immediate. It's undeniable.
And then, finally, you have to tackle the beta head-on. Don't hide from it. Acknowledge that a beta over 2.0 offers leveraged returns, but yes, it also brings volatility that warrants some kind of discount.
But you don't stop there.
No.
You then explain how the strategic institutional backing you mentioned, guys like Tom Lee or the rumored interest from ARK, how that acts as a stabilizing counterbalance. It suggests that credible, smart money is doing the work and essentially setting a valuation floor.
And that explains the anomaly. It justifies why the market should be pricing it closer to that $53.50 target. By doing all this, managing the risks, using the right metrics, the report transforms from a narrative into a robust financial assessment.
It shows you understand the complexity of valuing a company like this in such a volatile space, not just the upside.
This has been a really detailed critique on what is a very exciting analysis. So to recap our three main suggestions for really maximizing its impact, it's all about strengthening the structure for that sophisticated reader.
First, you have to integrate and neutralize the bear case, address the ETH volatility risk and the MAVN regulatory questions head-on to build that institutional credibility.
Second, quantify Project Maven's contribution. Show the math. Show exactly how many dollars per share of that price target come from future staking revenue versus the current assets.
And third, move beyond the PE ratio. Supplement it with a strong price-to-NAV comparison. That's the metric that truly proves the valuation anomaly and properly contextualizes the stock's high beta.